Well, hey, thank you so much. I'm very excited. Once again, greetings to all of you. We have a presentation set up today, but also going to allow time for discussion, and so you can talk through that. And so it's not a massive presentation, but it'll be fun, and it's talking about an area that you probably don't typically hear about, which I think you'll appreciate. And it's one of the big challenges of small to mid-sized business owners, especially as you are advisors for them. And I think this will be relevant information for you as as you're trying to help them figure out the books. At the end of the day, they care about, is their business worth something, right? And so we're going to talk about that today. So this concept is called $4 million strategies, and it's actually, interestingly enough, it's something that I came across this year. That's why I'm really excited to talk about it. In the strategy field, which I'm at, and also having an accounting background, it's really fascinating. Most of the time people focus on growth, top line, right? They care about making net income, or EBITDA, right? In the case of if they're a company that's looking to get sold, but rarely do people look at, are they going to actually end up making money from their business? And so they focus on the EBITDA side, but they don't end up doing the right things to move forward to actually increase it more. The reality, half of my business is with private equity firms. And what I see, and by the way, I love them, and I also love my owners, but there's this truth that many times these private equity groups are just frankly taking advantage of business owners who don't know. They haven't played the game before, right? While in PE, this is all they do. They play the game. And so they have been up to bat so many more times. They understand what they're doing, as opposed to somebody who sold their business for the first time. They're frankly taken advantage of often, and they don't know it. Now, just to clarify, I've also seen them sell at the perfect opportunity time, and the PE firm gets hit with a bad situation too. I've seen that also, right? And so sometimes it happens both ways. But the goal, in my opinion, is it should be a win-win. I really do mean that. The goal should be whoever's selling their business is selling it for what they're trying to sell it for. And then number two, the organizations, the PE firm is able to buy that company and increase value, right? So it should be a win-win. But $4 million strategies is ultimately about this concept of how do we increase business value? We're going to do this in very different ways, how to de-risk your company. So this is a fascinating data point. The average business owner has 90% of their retirement is tied up in their business. Right? That's pretty scary, right? So when people are worried about the stock market, they honestly don't care that much because their money is in their business, right? That's how they're planning to retire. And so to be able to create value out of that business is absolutely critical. And so once again, as you guys are helping, from fiduciaries, if you may, to help them make sure they know what their numbers are, that's one big piece of the puzzle. But are they doing the other side behind it, which we'll talk about here? The other crazy part, and once again, my current company, 40 Strategy, we spent a lot of time with organizations with strategic plans, and I've been really fortunate to be a part of a lot of successful companies. I didn't know until I opened up the US office for a strategic planning software company based out of Australia that most people are absolutely terrible at strategic planning. I experienced this firsthand. We had thousands of clients throughout the US, throughout the world, and we saw time and time again people create plans, and then it would collect dust. And here they were buying our software tool, think it would solve the world's problems, but it didn't. And so as a result of that, so that's one big thing. And another big reason why they fail, and there's multiple reasons, but the key reason is because traditional tools that are there for value risk, they lack objective data. Raise your hand. Who's done a SWOT before? Okay, right. Should be most of you have somehow done no, this is not everybody has, some people have. Okay, but a SWOT has been around since the 60s. Okay. And it's this, I would argue, the most common tool that's used to help prepare for a strategic planning process. And so typically what people do, if those aren't familiar with it, is they'll figure out, okay, they'll ask people, what's your strengths? What's your weaknesses? And that's internal. And then they externally will look at what's the opportunities we have to grow our business and what are the threats to our business. Now, the problem when doing this is most often this is an internal view of the world. So they're going, oh, we think this is our strengths. We think this is our weaknesses. We think these are our opportunities. We think these are our threats. There's rarely a external component around this. And actually, one of my worst things, forgive me here for everybody's here if you've been a part of this, done a SWOT beforehand, but you'll say, what's your strengths? And about 99% of the time, they'll be like, our people are our strength, right? And it's almost laugh out loud funny because it's not always true, but it's like their own kind of self-evaluation. Hey, we're great because I'm here, kind of type thing. They're not comparing themselves versus the outside world of like, do they really know they're great? Are they really A players compared to the best companies in the world? And so they're just kind of viewing it, we like each other is really what they're saying. Typically when they say they're good people, but that's honestly not very helpful to know that. What we need to know is it really helping them? Weaknesses, once again, are typically pretty not very helpful. Opportunities and threats, we won't even go into that much. But what was really interesting is Michael Porter on the right-hand side there, he hated SWOT so much, he actually developed his own framework. He's like, that's the dumbest tool in the world. We need to do this new framework. Well, he did this very intense different pieces of looking at these 5 different areas of like, hey, these are the most important things to look at. The problem is these things on the right-hand side, if you're a small to mid-sized company, you cannot get this information, right? You might know internal competition, but you don't know new entrants very well. You don't know the power of suppliers, power of the customers, ability of customers to find substitutes. Like it's not as well known. It's much more of a data driven. It's a data driven thing, and it actually costs a lot of money to get this information. A small to mid sized company typically doesn't have it. So what happened is people said, well, that's really cute, but they just went back to the SWOT because it was the easy thing to do. Big issue is people think they're developing strategy and they totally miss the point, right, of what they're trying to accomplish. Just real briefly, I won't go into multiple different things here, but I've been really fortunate to be part of multiple different companies that have been successful. I have 2 different podcasts that are out there. One is a weekly podcast called the Measure Success Podcast, where we talk with top leaders about effective strategies that inspire success. And what really excited, we just recently launched the $4 Million Strategy Podcast. It's just a 4-minute podcast. We want it to be the best 4 minutes of business. It's literally talking about these risks. So I talk 1 or 2 times a week. And then we have 3 to 4 experts a week sharing their best practices in all these different 40 risk areas that we'll talk about. I've been internally with companies, managed 7 different companies between 2x and 7x in size. So, and basically the companies roughly range from startup to up to about 100 million, just giving you a proximity of the companies that I've generally worked for. 17 years is probably even dated, but yeah, been a long time to C-suite experience. To date, 90% of our clients are referral, but for the first time ever, actually, we're being very active in going outbound, like literally because we now have this tool where we can help people assess more effectively. And I also have, if you haven't read it, there's a book, Lost the CEO, and you can actually, if you want to, you can get it for 99 cents. Hey, awesome, Crystal. Thank you. And you can get it actually for 99 cents on an ebook if you want to on Amazon. And my kind request for everyone who's listening here, if you get a chance, just do an actual review, what you feel. It's an easy read. One of my best backhanded comments was really funny. I was in Maryland, and I handed to somebody who's this particular person is a professor at the University of Maryland. She handed over to a friend, and she took the book with the intention of falling asleep. So that's what I heard afterwards. And she said it was so good she couldn't fall asleep. She had to get another book. So that was like my favorite backhanded comment of like, it actually is a fun read. It's a quick read, but it goes behind these insights of the captain strategy process, which we're not going to go too much into today. All right, so if you talk to an owner today and they are actually considering selling their business, there's a concept, EBITDA times the multiple is the business company value. So what people typically think is they go, oh, well, we just go on the internet and that's it. That's the number. It's a 3x multiple or a 4x multiple or a 4.2 multiple or 7 multiple, right? That's the belief. The problem with that belief is, once again, it's not necessarily true. And so with that, so that's the big problem, right? Is people just presume it. And the reality is that's an average number that comes from the market. So the reality is most people are getting less than average, right? It's the outliers that end up skewing up the average, but the reality is most people are getting much less. And the why is because of risk. Okay, so there's just this weigh scale, and that's why we have this weigh scale here. So the reality is if you have a less risky company, people are willing to pay more for it. That's why the multiple goes up. If the company has too much risk, they'll pay less for it. So this is what happens a lot of times with small business company, even larger business companies, is they'll go through this process and like, oh, we got it figured out. We're gonna sell. We're so excited, and they get this multiple that's way less. And like, what happened? Well, they didn't realize they didn't prepare their company really for sale. They like may have got the P&L ready, but they've left the money on the table, which they don't even realize. And once again, the PE company will take advantage of because they will end up fixing this risk before they sell it again. Matter of fact, I was we're sitting there with a company and we showed them this tool and they went through it and they said, Carl, this was a 4-time operator. So meaning he's been a part of 4 PE deals. And that's very uncommon, by the way. And he said he went through it and he said, Carl, what this tool has told me is exactly what I've been telling my management team for years, but now I have a number to help figure it out. Now I have data to figure it out. So we'll go in more into this in just a moment. So this is the crazy part. So let's just say, just for simplicity, let's assume we have $1 million EBITDA company. Once again, assume you all know that earnings before interest, taxes, depreciation, and amortization times a 3x multiple. That means the company by definition would be worth $3 million. The problem is the average company has a 57% discount from what it could be worth if it was de-risked. So keep in mind, this is the average. We're looking at average industries, average multiples. There's always outliers, lower and higher. All right, so noted. I read that we're just trying to take the average here just for conversation's sake. But if you take 1 million EBITDA times a 7x multiple, you can get $7 million in data. 7 million. That's a huge difference. I mean, think about it from a retirement perspective. Selling your company for 3 million or selling your company for 7 million. Let's pop in taxes just for fun here. 3 million. Let's assume you get half of it just for simplicity, $1.5 million. Okay, if you're planning to have 20 years after your retirement, right? It's like, should we sell your business? Question mark. Sell it for 7, you get 3.5. That's a much different. You could have a lot more flexibility in your life, right? What you're gonna do with 3.5 million. So that $4 million is what we're trying to capture. And what I'm excited for you to have this information so you can help your clients understand this so they can start working on it sooner rather than later. So the opportunity, the problem is there's so many risks, right? It's like, well, how many risks are there? There's a lot of risk. The key is how do we identify the biggest risk so that you can focus on those strategies and bring you higher ROI, right? That's the goal behind everything is how can we get the highest return on investment behind what we're trying to do. And what's cool is if you focus on the right things, you can get a lot of difference quickly. So you can make, a difference between $1 to $2 million of value. And keep in mind, right, the larger the EBITDA, the greater the impact. And what's really fascinating is when you start fixing your risk, your business is more enjoyable to have. Right. A lot of times people why they end up selling is because they don't have an heir. They don't have a manager that they can run the business. And so they're kind of like, oh, I need to get rid of this. And they're willing to sell it for less. As opposed to who somebody's really thinking through the process. They're like, oh, no, no, no. I really want to create more value. Even better yet, what I like to say is why not become a shareholder of your own business? Have it become an oil well, right? By decreasing your risk, you're more willing to do that or be willing to sell at a higher value. Either way is a good thing. So what are these 40 strategies, these 40 different risk areas, and we help evaluate them. And we're going to just, I'm going to scan through these, okay, folks, because this is like a lot of different risk areas, but here they are. We have money matter issues from margins and like stuff you do, financial reporting, having a budget, financial forecast. These all matter. Matter of fact, if you put all this information together, sometimes just what you do can bring $1 million in value to a business. Kind of nuts, right? If an acquiring company comes in, they're like, wow, we had the opportunity to like create more value out of it. This is like the tough, and what I'm gonna be able to show you later is we actually have the data to prove it, okay? As opposed to it just being a cute idea. Oh, that's cute, Carl. It's like that's a really nice idea. No, it's like we have like data now to prove this information. And by the way, I wish I've had this for the past 20 years. I mean, literally, this is something that we uncovered this year because of data, AI, tools, software. It's just stuff that we now have access to that we didn't have access to in the past. All right, other areas. Okay, there's more than just financials, right? Do you have a good culture? Do you have strong leadership? Is it productive workforce? Do you know how to hire people? Do you know how to onboard people? Is there ongoing training, right? So these are all different areas. On the people side, you have strategy, right? It's interesting. If you're selling, I remember when I joined one of my best companies I ever worked for, where I learned the most amount of strategy I ever had, was part of the reason I joined them is they had this incredible strategic plan, and I got to read it ahead of time. I was like, wow, these people know what they're doing. Well, that's exactly the same thing that your employees have, your management team has, and in a company that's trying to buy you. If you have a clean and clear story as to what your vision is, and by the way, this is what I spend a lot of my time in my career as I do this stuff today. What's your vision? What's your plan? Are you planning? And do you know how to execute it? Right. So that's where I spend a lot of my time and helping out with the story. Value stream mapping. If you're familiar with that process, that's more about operational sales backlog. Okay, this gets into sales and marketing. Do you actually have a sales and marketing process? Do you have legal and IP, right, taken care of? Like, are your books aligned? Do you have strong corporate governance? Okay, these all things matter, and they all come out in due diligence, by the way, right? This is by the way is a little problem. You can't fix it after you hire your investment banker. This is like a really important point. When the investment banker comes in, they're going to take your risk at where you're at when you sign with them. They hurt you if you're not already cleaned up. They'll tell you, oh, we'll help you clean it up. No, the reality is their view of you is on day one. It's like the first date. Like, you're not going to change the way from the look from that, even though you've got a prettier dress on, so to speak, right? It's like, no, they're going to actually, when they're talking to people in the outside world, they're going to actually value you based on the initial point. And so it's important in many cases to do this before investment banking. Next piece is behind this. And don't get me wrong, there are some really good investment bankers out there that will do some of their work ahead of time, but you're going to pay much higher fees and work and effort to get it done when you don't have to. And then other things, there's market share, size, customer satisfaction, customer base, strong brand, strong SOPs. And some of these things can be fixed so much faster because of AI today. I mean, like SOPs as an example, that used to be so overwhelming. There's so many tools now, you could do it so much faster and get it done through this. All right, so now what we're going to do is give an example of what our tool helps provide results with. Stackflow, by the way, is a made-up company. It's in my book, Lost at CEO. That's the story of the company that we talk about. So we put Stackflow under our tool, and what this shows here is their top 3 risk bring back this much value, 309,000 if you have a strong financial reporting process. So this is like from your perspective as Breakaway. If you can help them create a strong financial reporting process, in this example, you could bring $309,000 of value to them. That's a much different conversation, isn't it? Rather than your monthly fees or annual retainer that you're working with somebody. This is just in the strong financial reporting process. A strong culture. Yeah, people actually, this is one of the strengths that I'll go back to what I was kidding on before, and people actually get along and they actually are trying to get to the goal of getting somewhere. That matters. They have strong SOPs. That matters, right? All these areas creates value. So in this specific example here, and this is, by the way, I took this information based on our actually working with clients. So this is like examples of real, actual practical clients. It's just not, we put in, once again, a fictitious thing just from practicality standpoint. But just the first one example, you could get 8% of that risk back, 15% with 2 of them, 21% of 3 of them. In many cases, we found if you just fix the first 3 things, you could get nearly a quarter of the value back in your company, or nearly $1 million in this specific example. You take the top 8 risk, you could get nearly 50%. Once again, this could vary for company to company. But how cool is this, right? To be able to tell your clients, hey, we work on these different things. We get an ROI out of it. It's not just because I want it to be done. It's like, this is going to help us out. It's going to create value. And you're going to be able to sleep better at night, I like to say, when you have this stuff done. And then what's really cool is what we do is we actually measure this every quarter. So every single quarter will match the change in the business. And we'll show it from 2 perspectives. We'll show assuming EBITDA doesn't change at all, will show, that part, and then we'll also show the growth from de-risking your company. This is just taking an overall look. But how cool, once again, is that you can show your clients, hey, by focusing on these things. Now, has everyone heard the Hawthorne effect beforehand? So the Hawthorne effect basically is once you start measuring something, it starts getting improved. Okay. Even if you don't like have a plan, it literally will start improving because if you're seeing something every quarter, you're like, oh my gosh, I need to improve this risk or I need to improve my value. You start working on it. It's sort of like if you're, go on the weigh scale each day, right? You're going to probably pay a little bit more attention and not eat that cinnamon roll that it's an insomnia that I really want to eat every single day. It's like you're going to make perhaps a better decision and have it maybe only once a month because you didn't eat it every single day of the rest of the month, right? So you try to be a little bit more thoughtful. Well, same thing happens with this. When you are aware of it, you'll start improving, you'll start getting better. But what we like to, so this is once again, we do this, around the value. So, but this is the core. Once again, we're going to have more time to talk about this. This is the core of what we wanted to talk about is when going through this process, this $4 million strategies, we can create a tremendous amount of value. I want to be really clear here. This is not a sales pitch. If you are interested in applying this to your clients, if you could go ahead and you could put your phone up and we have a tool, right, where we can do a preliminary assessment with no cost. We can do the first level. Now, it's not going to tell them the dollar amount, but it's going to tell them what areas are at risk. And so we can do a preliminary piece behind it. And once again, we'll do that at no charge. And then if they want to get the quarterly updates, if they want to get the information, and by the way, like you can do it with one person, but we actually get information where we can get the entire leadership team to enter the information. So we get a consolidated answer or a consensus answer. And we put that information into it. And then we can get a real answer to how the business is going, not just sometimes owners are, as you know, sometimes they're too positive, sometimes they're too negative. But when you get the rest of the management team in together, or whoever they are, whether it's once again, depending on the size of the company, you can get better information. So go ahead and use that. You can help to apply. We can help you start with the process with anyone of your clients. And we can get that first conversation with them to see this data, see this information, what's taking place. All right, so I wasn't planning to talk about this next thing, but we ourselves have opened up something that might be very beneficial. And I talked to Crystal about this beforehand. So we have started doing taxes. What we've recognized, right, with our clients is, my background is I was a CPA. I didn't mention this beforehand. I started out PricewaterhouseCoopers or Coopers Lybrand and PricewaterhouseCoopers. That was my background. That's where I started out at. As a matter of fact, I had a CPA firm, and I little true story. I was planning to be a teacher. I would start the business world. I was going to teach history, coach high school football. That was part of the plan. And I built up this tax practice, and the goal was to help supplement my income while I become a teacher. But then the company I said was an amazing company to work for. They said, Carl, we'd love you to invest in you, but not if you're going to leave and do this. And so I ended up selling my business and then going and offering the business world and had these amazing business opportunities, which I'm very grateful I ended up doing. But here we are back again. Now we have our tax firm is back. And the purpose behind this is there's a massive, as you all know, there's a massive gap in CPAs out there, right? That's why you all exist. And you don't even know who to refer anybody to. There's like one person and they're too busy and they're not answering calls anyways. So we are built to scale. I've opened this business up with Nick Cuttigan, who is also a CPA, came from KPMG. Sorry, I think he's transitioning to the active stage right now, if that makes sense as well. But we have expertise in this, and we have a great tech stack, and we have people on the side who help out with the process. And what I like about what you all do, I think a lot of your clients, I think, are QBO clients. Isn't that correct? So we can make it very cost effective and essential for it. So we have a very simple tax made process. The thing that's different than most of tax accountants, we actually connect with our clients every quarter. Not just sending them, this is what you pay for quarterly. We actually meet with them in a Zoom call and say, hey, we want to connect with them. If you have any concerns or questions, and we want to make sure there's no surprises when they actually file their taxes at the end of the year. Okay. So, and what we really excited about potentially partnering with you all on this is you have problems and you're not getting good tax advice, right? Good CPAs that are available. They're not contacting, they're hard to get a hold of, or at least you don't even have, at least you have somebody else to recommend to. Um, it's wonderful when it's already clean books. So if you're already providing clean books for them, it just makes it, you know, really quick and easy for us. We can partner well on that. So our goal is to help make things simple. We have a very simple business model. So basically, $12.95 per year we'll get the taxes done. Okay, and then if they want to add in their personal side, just 250 on top of that. Okay, but that includes the quarterly tax reviews. And our goal, just to clarify, is to not do extensions. So we believe in most cases, if our people have things taken care of, and then if we have clients, we can refer back to you. Hey, we got a problem with the things that are happening here. But if books are kept up, there should be no reason there's ever extensions. And then we do personal consension. We create success plans. So if you have things on that, you can do that. This is a question piece. But what I now wanted to open up the floor to questions, comments, thoughts behind what you heard today. Yeah, sure.
Carl, so the tax piece is clear, like how we could partner with you guys on the tax piece, but what would a successful partnership look like if we wanted to bring you a client for improvements for valuation?
Yeah, so pretty simple process. So we can connect, and by the way, we haven't talked formally, if that makes sense, from any type of a business, but just if we were just pure simple, the tool that I talked about just is a $4,000 tool. That's it, and it's very simple to very cost effective. We provide it for 3 years, the data and information for it, and we guarantee a 10x return. So meaning if we can't validate a $40,000 increase in the value of their business, they get their money back. So this is like the biggest no-brainer in like the history of, like, they get clearly identified data points, and beyond that, they can figure out what to work on. Now, you say, well, Carl, why are you doing this? Like, literally the cost to do this is like $37,000. Just to let you know, if you add in the software, you add in the time that we do, the rationale behind that. Well, why would I do that? The reason why I would do that is because our opportunity later on is they might ask us to help them out with those implementations. So we have different packages where we're like, oh, hey, Carl, can you now help us do a strategic plan? Can you help us do different pieces, right? So we have the ability to, because we can put multiple clients on the tool, and B, we can then identify and go, well, have you considered, right? Because every quarter we're seeing if they are or not working on things, and they might go, hey, would you be interested in doing that? And so it's part of our way to connect with clients, but at the same time, even if they don't ever work with us, it's awesome value. That's what we want to do with our clients, is we want them to go away going, hey, this is one of the best things I've ever seen. I'm super curious and I want to start working on it. So that's the easy way. And literally that original QR code that I sent beforehand, once again, we'll send this deck to everybody. Take a picture of that, get the process started. My email, which I think is also in the deck, but I'll just say it out loud here, is Carl J. Cox at 40strategy.com, 40strategy.com. And so feel free, you can just send me an email and say, hey, Carl, I got somebody, let's talk about this. And you're like, hey, I don't remember what we're supposed to do. We can get the process going very quickly. Once again, no cost initially. They can get the basic information, but if they want to know the numbers behind it and actually get it to be a regular tool, then it makes sense. And that's where that conversation is there. So
Yeah, so with the $4,000 buy-in, how much of that is like SaaS versus like advisory? So just
majority,
software.
oh, sorry, good question. Software cost is
We will
it's
allow
about
estimates.
it's about half and half depending on the fees that we charge on it. So because once we provide the information, we meet with them quarterly to go through the update. So it's if we did our full part, it's about 50/50.
Can you talk about, like, your existing client base? Is a lot of what you have preparing for sale, or is a lot of or is there quite a bit of it EBITDA improvement? Just trying to get a sense as to, because I think the guidance would be a little bit different based on the client.
Yeah, so just to clarify, half of our clients are PE and half are not. Some of them are in the process, or they already have an investor and they're heading down that path. The other half are like, no, I don't want to sell my business. I love my business. I just want to grow it, but they're stressed. And what's nice about the tool, once again, I'm going back to let's go back to the original part of the slide deck. Often the experience is, I don't know why I'm stressed out about my business, or they know it, but they can't put into words. And what this tool does is it helps. It actually, what I haven't shared with you, because it's pretty in-depth analysis and survey assessment. It's going into detail of, like, we do this initial assessment, but we could take a deeper level assessment once they pay for it. And we're asking questions. Hey, do you have documented procedures? Are they always there?
Yeah.
You know, we're going into the details. And so it's asking very specific, pointed questions about their business. And so it's no longer when they get through it, you know how sometimes you take a survey and you're like, it's like, I knew that. It's like this actually, the experience of every single person we've gone through this, every single client, they're like, whoa, I need to now work on that because I'm frustrated. I now know there's value, and I now know what the problem is, right? A lot of times they don't even know the problem. And so going back to, if you can help fix these risks, they're far more likely to, I've said this multiple times, to like their business, to not to be stressed about what's going on, right? The best business, like best business as an owner, when it's run, you could go on vacation and not have to worry, right?
Yeah.
That's a well-run business. You could take a 2-week vacation and not check your email. That is the type of business that gets high valuations. If you ask a lot of your owners, can you do that? It tells you everything. What's nice about this is the data validates the what, why, why you're not sleeping. Oh, yeah, I can't. You're right. I can't take 2 weeks. Are you kidding me? I can't take 2 weeks off. Okay, well, why can't you? The tool helps discern it much faster, right? Than a lot of other things are. It literally accelerates our strategic planning methodology so much faster. I mean, we still do traditional things, we still come up with a plan, and still, our core thing is, but a lot of small clients, they just need to fix one thing at a time. Like, we actually recommend, we have a, just to give you, like, our $7,000 packages, we meet with them on a monthly basis and just focus on one thing at a time. Hey, let's just fix this one risk area this quarter, right? And the next quarter, fix the next risk area, next quarter. And so they had this small, nice incremental improvement. Other people are like, no, we need to go all in because we are selling in 2 years. And I say, okay, are you really selling in 2 years or 3 years? Well, really 3. Because it takes a year to sell your business in most cases, right?
Yeah.
So it's like, no, you have 2 years to get your value back, and let's work on that through the way, and let's go kind of all in to develop that. But it's not a one. So going back to the original thing, man, we work with literally single business owners, small business starting, to companies up a couple hundred million. Our vast majority of my space is probably 500,000, $1 million in revenue, 500,000, $1 million in revenue, up to 50 million is probably the vast majority of our clients. But we do have larger one. All right. So there's some questions people are asking, and I have not been checking this out. All right. Are you brokering some of the deals? Michelle, he was asking this. By definition, I'm not a business broker, if that makes sense, but I do have people that are connected to it. What I will say is I help give both sides confidence in the deal. So that is something I do play with. And I was working with somebody recently. It was just they were just changing investors, and I just was help guiding them in a scary process that they never dealt with beforehand. And they just appreciated that value, right? Of getting help along the way and getting guidance and stuff. So what other thoughts, questions, comments?
Hey, Carl. I have a question about, so you're applying dollar amounts to the risk. And when you're doing that, how is that based on historical information, and how accurate is that when you actually when your clients are going through with a business deal, that they're seeing that increase in valuation?
Yeah, it's so first of all, 2 things. One is we take the assessment each quarter, right? So we actually are taking where the risk within the company, internal view first. So that's number one. So it is the best accurate, but it's comparing it to market data. So whatever conditions happening in the market, if it's literally the multiples change by definition, because like right now, as you know, with interest rates being higher, the multiples have gone down. right? Because risk-free rate, so that's been hurting the market valuations. Perhaps the industry is not doing as well or is doing better, right? It counts for all of that when it's pulling the dollar value in total that it could potentially be worth. So it's comparing all those different risk factors that we mentioned to actual market data by industry, by revenue, by margin, and by percent margin. All those have an impact on this. One of the things I was curious about when we got involved with this is, is this like legit, right? Is this like really good? And we've had multiple appraisals look at it, and they're like, how many of you all been involved in the appraisal process beforehand? Have you ever been involved in that process? Cool. Let me just ask, when you go through it, do you like have absolute confidence the number's right? No, it's can't you tell that the appraiser is like trying to get how risky the company is? Like all their questions are based on risk. Yeah, the numbers are the numbers, right? The numbers are the easy thing. The hard part is, what is this really worth? And so they basically justify everything to get the discount to a certain number. Like that's my experience, just frankly. My experience now, I'm not an appraiser, and they'll probably like, oh, no, no, no. I mean, they'll tell you something different. And forgive me if somebody's an appraiser here, and they're like, it's way more technical than that. But my experience is it's a little bit of voodoo, behind it all. The voodoo is the risk. And what's nice about this is it puts a number on the risk. So does that help out? That answer your question? Just wanted to make sure.
Yeah, I think that helps for sure. That is more of an appraisal type of process when you're looking at the dollar amounts. Because my only concern would be if we're looking at this and we're helping a client out with this, and we're saying, okay, we're taking you from $2 million to $4 million. What's the level of confidence that they have that it actually did double the value? If we're going to say that, to the client, that's kind of where I'm coming from there as far as the dollar value. I have a follow-up question too on risk. So I worked a lot in risk, in the risk space, enterprise risk management type space. How closely is this tool aligned to like an ERM model versus is it really more driving business valuation, whereas enterprise risk management is more focused on reducing overall company risk and efficiencies?
Yeah, I think they're similar but not the same.
Yeah.
This is much more driven to risk side from the worth of it, right? Versus risk of something failing. However, at the same time, there's some similarities there, right? I mean, like IT, for example, right? If you have a risk of your IT going wrong, I mean that's a whole business in itself, right? Which is just IT risk management. And just to clarify here, I just want to say this real quick. We are not an expert in all these 40 areas, right? That they're out there that get evaluated. So we have a huge partner of people of like when we see there's something wrong, it's like, hey, we can't fix that. That's not our expertise. That's part of the reason we love to have partnerships. So like here's one or two or three people that we know that fixed that, right? From a recommendation standpoint. So hopefully that helps answer your thing. It's not the same, but there's similarities that you see when you would see the questions and what's taking place. A question was, I would assume you provide detailed project plans. So if they engage us to work on it, yes, we help them create a project plan. Absolutely. So who you don't see on this, but Crystal communicated a lot with is Tanya Smith. She's our director of operations. She actually has a doctorate in leadership and she's a PMP. And so we help create detailed project plans. When we really get involved with our clients, like they want to go all in, we actually help them implement weekly implementation sprints. The only thing I love strategic planning, I hate it when they don't get done. Like I hate it. There's a lot of people, smart people, probably I'll just say better than me, and coming up with a plan.
From a continuity perspective, it's difficult, right, for a lot of clients to stick to something unless they really understand the details behind it, the actual execution, right? So kind of why I asked the question.
Yeah. No, it's like, no, this is how we're going to help solve it. We work with them. We have to understand their business, right? So once again, we're not doing this in a vacuum. And but yeah, we come up with a plan, and once again, if they get more heavily involved, we're keeping them accountable, right? A big part of what I do, because of the way we meet regularly with our clients, is people don't want to show up to the meeting not getting their stuff done. I mean, it's sort of like, when you work with your clients and like they don't know they're meeting with you, and like the financials, like they want to make sure it's done, right? And so when they pay for an engagement, right, when they put money down on it, like, oh no, this is worthwhile doing, worthwhile correcting. And yeah, they don't want to see each period it not changing, right? They don't want to see that information because all of a sudden they're finally going, hey, we should maybe consider working on that, behind it. And as I said, often these risks that are in there, it's why their EBITDA is not growing. Their cash flow is not growing. Like, you don't have a good outbound sales process. Oh no, we just wait for referrals. How's that working for you? Right. As all entrepreneurs here, we know how that works, right? Right. And part of the reason you're connected with Breakaway is like Breakaway helps provide leads and provides contact. Well, people who don't have that, it's lumpy business, right? It's haphazard. But if you have a clear process in sales and marketing, which is one of the risks, a couple of risks identified, surprise, right? You get better business. I'm doing something to help do sales growth right here is by speaking, right? The reason why I have my book, it's the best business card in the world, right? These are all marketing materials and things that they do to help improve. So we have a scalable marketing process and then we have a scalable sales process, right? They both go hand in hand together with it. So yeah, those totally matter. Great questions, thoughts. All right, what else? What other thoughts or questions?
There's another question in the chat.
Oh yeah, great question. What would be the typical turnaround time? So if we had their time, their effort, just to clarify, is about for the full assessment is about 90 minutes. So as soon as we get them, and assuming their team is doing it concurrently or even they're doing it independently, but their actual individual time is about 90 minutes. And then we meet with them. Sometimes we go with them in person doing it because they don't sometimes understand the terms, by the way, depending on how savviness they are with things. So we sometimes go with them, but a 90-minute event, that's it. And doing it future, it's easy because it's just doing updates, right? When it goes through with it, so it's a little bit easier during that period of time because you're familiar with the questions. But from a practical standpoint, it takes us 3 hours or less than a half day in total to come up with the first solution. So they can get this pretty fast. We have once again, we're using software. We use a smart sheet to help gather the information, the assessment. We put it into our software tool, and then we provide them the information, meet with them. If they decide to help come up with a plan, right, that goes on our next side of engagement. But the whole purpose is intended to be quick. I mean, honestly, why we're going outbound ourselves for the first time is we now have a scalable tool. My traditional method of doing this was long and manual. It took a long time to do interviews over everybody to figure out what this information is telling us in 90 minutes. So it's super more valuable, way more, this is the beauty of software and AI, right? We can get information so much faster than we used to compared to how it was today. So hopefully that helps you out. Assuming like if we could like literally meet with somebody in person for a half day, it's done. So it's a very quick process.
We have another question from Michelle Rose. What is the ideal timeline to work with a client to maximize value?
Yeah, I think if it depends on how many people you have to fix things. So I'll say that, and how much resources, time and effort that you have. But if you have high risk, so the average, I didn't show you some of the gauges that we have here, but if you did a scale from like 1 to 100, the average company comes out about 38.5, meaning not very good. Okay. Really good companies come around 70, 75-ish. Very few companies that are 100. So it honestly comes down to a return on investment evaluation of like how many things you want to work on. So I feel you can get a company if your EBITDA is in pretty good shape. Let me clarify that statement. If your EBITDA is in pretty good shape as is, but you still want it to grow, I think once again, 2 years is plenty of time to get ready to the point to sell. And then once again, you have a year in general, you have to plan for the actual sale to take place. I'm working with a private equity firm with an investment banker right now on a company that has all its ducks in a row. And it's still taking a year. And these are all experienced people. They know exactly what they're doing. It's amazing how long an investment. Business brokering is different. Business brokering is faster. You just get less multiple, right? There's a reason why everyone's getting paid less, right, through that process. You're paying between 5 and 10% to a broker, sometimes more, but you're getting way less than the multiples, right? This is why we're talking about one-time revenue type things and things of that nature, right? And then that's sometimes spread out over 5 years if you're a services-based business. So yeah, that can vary significantly depending on what the business is. So hopefully that helps. Michelle, what I would say is don't sell your business until you can maximize it, but in between that point of like you're ready to be done with it. What I do find though is once again, you fix things up. I said this is not a bad thing. 50% of business deals fail at the sale point. They fail. People aren't willing to sell, or the buyers aren't willing to buy. Despite everything happening, 50% of them fail. This is why doing this exercise is valuable, because you don't hate your business as much when you don't have as much risk in the business. I keep on saying that over and over again, right? Why not, if you have the energy and the vitality, or if you have a management team that you can hire, bring in, or general manager, why not create an oil well? Why worry about the stock market, right? Why not create something that you can get continuous quote unquote dividends every single period of time? I mean, that's what I would prefer an owner to say, unless they get stupid money. When you're getting 7 to 10x, yeah, that's a decade of work. I'll trade that. Right? You know what I mean? So there's this trade-off period, I think, for every person. I met this guy the other day, this is like 2 years ago, and I was asking him, he just left a business. And I was like, so what did you get paid? And he said, I got paid 20x. I was like, okay, game, good job. It's just like, good job. You have to sell. When somebody's telling you 20x, almost always you have to sell, because there's a reason it was a stupid valuation at that point in time.
Awesome. Carl, I just want to thank you so very much for joining us today. You and I have some fun things in the works, and I will touch base with you and Tanya about that. But I do encourage all of you to go buy Lost at CEO. It really is a fun, awesome read. Again, we have included the link in the advisor community on Slack for you to get that 99-cent coffee. Thank you, Carl, for that awesome opportunity. And yeah, a little nod to the Navy too, Michelle Rose says. So Carl, thank you again. And we really appreciate your time.
Thank you. I appreciate it. It's been an honor to speak in front of all of you. And I once again, in any way, shape, or form, and once again, this is a two-way street, right? When we have the need of we have limited resources ourselves. And so we have the need of people who need bookkeeping or CFO type services. We're aware of what you have. And once again, we're hoping to be your need when you hear on the other side, when they don't have, or they don't have somebody who's servicing as well as they can on the tax side. And so the $4 million strategy, as I said, to me, it's the biggest no-brainer in business. Guaranteed 10x return, like literally, I'll give them their money back if we don't get those results, even if they don't do them. Okay, so just to let you know, that literally I'll put that's I'm so confident in doing what we do behind that. So, anyways, thank you so much. It's been an absolute pleasure, Crystal. Thanks for setting this all up, and look forward to engaging. And I'm sure we'll create some ways to create some easier way. But in between the two different things, QR codes and my email, feel free to connect if you have something immediate you'd like to follow up with.
Much appreciated. Thank you, Carl.
Thank you. Have a great day.